Hello, friends. Welcome to another episode of Ask Marco on the Passive Real Estate Investing Show. Well, I have an interesting question today from a guy named Shane. Before I jump into that, just wanted to remind you, if you're new to the show or if you haven't subscribed yet in the past, please remember to do so. It takes you 3 minutes. You never miss an episode. And we've got all kinds of great content covering all kinds of topics, but mostly about real estate and, of course, investing and finance. So remember to subscribe if you haven't done so already. So today I'm actually recording not from my regular office, but from my home office. So hopefully the audio is coming out well. I do have my professional microphone here, but there is always noise around. So Shane writes in and says, "Hi, Marco. I found your podcast a couple of weeks ago and I have been listening for hours each day while I am currently building our home. I am in my 50s and my wife and I have been married for 28 years and we feel like we have made sound investments in the past 12 years since we lost our home and all of our investments during the 2008 recession." Well, I'm very sorry to hear that. "I have so many questions about what to do with our current and future investments that we are thinking about diving into since listening to you and your guests on your very informative show. I've already purchased 3 of the books you've recommended, and I'm trying to learn as much as possible so as to not make the same mistakes as before 2008. I'm a general contractor and know how to do pretty much anything on a home, whether new or an existing remodel to flip. We are debt free and wanted to buy some homes or multi unit housing to rent out with some money we are receiving from an investment using a 1031 exchange. We will have 2 homes as our personal property and are going to do nightly rentals with the existing home we currently live in after we finish our other home." Okay, interesting idea. "I have a company that will take care of the 1031 exchange, but my wife and I are wondering where to buy real estate. And do we buy multiple inexpensive properties or just pay cash for one property for rentals?" I assume you mean a more expensive property versus multiple inexpensive properties. And then Shane goes on to say, "Do we buy near us or should we buy an existing home or multiplex somewhere more inexpensive than where we live? Do we apply for a HELOC, like a home equity line of credit, on our personal property and buy more homes or just try to stay debt free with our home? We know we only have 180 days to transfer it to another property." And he's referring to the 1031 exchange here, "to another property, and didn't want to go into more debt unless you think it would be beneficial to do so for our retirement. My vivid vision is I would like to purchase as many rental properties as I can in the next 10 years so we can retire and follow our vivid vision and do service projects for people that can't help themselves even more than we already do now. I feel like I can't buy as many rental properties as I would like to unless we take on debt for the properties. I've I have disliked debt since 2008 and never want to lose my portfolio again with an exclamation mark. It made us strong and resilient and taught us to pay cash for everything, but we are up for suggestions now that we can invest in other things. Thank you, Shane." Great email. And thank you for the questions, Shane. This is great. So you've got a lot to unpack in here. So let me do my best to address and answer as much as I can. So first and foremost, thank you for being such a loyal listener. That it's a huge compliment, very big compliment. I really appreciate that. I'm glad you're getting a lot of content and value from the show. I try and put as much as I can out there, and I try and bring in, a wide variety of guests to educate on a variety of different topics. So thank you for being a loyal listener. I appreciate that. And I'm also sorry to hear about your losses back from 2008 and what we ultimately ended up calling the Great Recession. A lot of people, and I'm talking millions of people, were affected directly and indirectly from that. A lot of people lost their homes, their savings, their rental properties or investment properties, as they called them, even though many of them were not investment or rental properties. They were speculative plays, but I don't know what you did. But anyway, I'm sorry to hear about those losses back in 2008. But, it seems like there's always a silver lining. Anytime there's a kick in the gut, a downturn, a recession, a pullback, whatever you want to call it, it seems like more often than not, we come out of it better, stronger, with a better education, more wisdom. And at least that's the way I look at it. And that's what I try and do as well. So I'm glad that you've come out a lot better and stronger from it. So, regarding the books, I'm glad you're reading some of the book recommendations I made. There are plenty of books out there, especially on the topic of real estate and investing in general, but real estate, there's just hundreds of them. Not all of them are great. Some of them are good. Some of them are great. Many of them are so-so. It's a lot of rehashing of the same information. But you know what? It's not like there's a new thing every month or every year when it comes to real estate investing. The principles and the strategies pretty much stay the same. Tactics might change from time to time, and you adapt your strategy based on the environment. Are we in a recession, borderline depression? Are interest rates high or low? Is access to capital easy? What is the availability of inventory? What is the affordability in the housing market like? There's so many variables, and things ebb and flow all the time. But strategies and principles more or less stay the same all the time. Tactics will change, and you adapt as the environment changes. Now, you asked some really good questions here about your wife and you wondering where to buy real estate. Well, this is a darn good question. It's kind of the number one question that investors ask all the time. And also, should you buy inexpensive properties? Sometimes people refer to those as cheap properties. Or should you pay cash, or should you leverage your investment? Well, let's talk about these things and break it down a little bit. I've gone into great detail in previous episodes over the years about market research, market types, market drivers, location, neighborhoods, etc., leveraging and financing and all that good stuff. So obviously, when you choose a market, you want to pick a market that's going to make the most sense. I've said for about 20 years now, live where you want, invest where it makes sense. A lot of investors seem to think that they should be investing in their own market, their own backyard, because they're familiar with it. But that doesn't make it a good investment. That doesn't make the market favorable. You want to invest in a market that's going to give you the best overall returns in terms of cash flows and price appreciation, which you can't control and is not always predictable. But you can look at the variables and the factors and the drivers that drive the market that will lead to strong appreciation potential. So you do your market research. I basically classify markets as three basic categories or general categories. I refer to them as tier 1, 2, and 3 markets. Tier 1s are the big metro areas like LA and New York. Of course, those are going to be divided up into submarkets and even smaller submarkets within those. And so there could be very, very good and attractive submarkets within a larger metro area. But in general terms, you want to look at a market to see if the numbers make sense in general. Is the market healthy? Is there inventory? Is there product to choose from, whether it's new construction or whether there's a good resale market? Is there enough inventory to choose from within the neighborhoods that you ultimately will be buying in? So tier 1 markets, you really have to break it down and be more granular. Tier 2 markets are typically my favorite. Those are the mid-sized markets. They're generally speaking 100, 200,000 to possibly 3, 4, 500,000 population as a whole. But places like Kansas City, Missouri, Indianapolis, Memphis, Tennessee, Jacksonville, Florida, these are all markets that I refer to as tier 2. And then, tertiary markets are the smaller bedroom communities. They're further out. They're smaller markets. So those are the markets that also make for good investments, as long as there's a feeder market, meaning that they're close to or relatively close to a larger market that offers all the amenities and shopping and everything else that's needed by the people who live in those smaller markets. Otherwise, if it's too small of a market, it's going to be it could be very cyclical. There could be a lot of noise. There could be a lot of volatility in that market because they're often driven by one or two industries or types of jobs. And if there's something that impacts that industry, like oil and gas, for example, it can have a huge impact or a huge effect on that market. So just keep that in mind. So do your market research. There are different market types, and then also there are markets that tend to be very cyclical in nature, where prices go up and down uh, fairly quickly. They're aggressive markets, and then there's also markets that are more subtle. I call them linear markets. They still appreciate, they still have cycles, but they're not as wild or aggressive as a more cyclical type of market. And of course, every market has its own drivers. What's driving that market, and often it comes down to jobs and job growth. Are there a lot of jobs in that market? Is there job growth? Are people moving there because there are employment opportunities or the opportunity to make more money? That's usually a major factor, if not the number one factor, that drives people into markets. So if you don't have jobs, people are going to ultimately leave at some point, in search of employment. So look at market drivers. The two biggest things I like to look at or consider in a market are the job environment, the job market. Is it growing, and are there jobs? And secondly, population growth. A long-term population growth is good for a real estate market. It's good for housing. A long-term population decline is going to be bad for housing. And Detroit is a great example of this, where there's been long-term, in terms of decades, of population either growth or decline. And so, it was a mega market many decades ago. It was kind of almost like the epicenter of the world, because it was the automotive industry. And then people were moving out, decade after decade, and it just became almost like a ghost town. There were so many neighborhoods and areas that were filled with vacant homes. So it's got its pros and cons, but that's not a good thing if you're an investor. Now, you made a comment about price. Should you buy inexpensive properties? I don't think you should be looking at price in isolation. And I've made the mistake long ago at buying, when I first went essentially full time in real estate investing, buying cheap homes or cheaper homes. And that basically pushed me into areas and neighborhoods that I would call less desirable, sketchy, questionable, sometimes scary. These are, generally speaking, what I'll refer to as a C class neighborhood, and sometimes a D class neighborhood, which is, some would argue, a war zone. I like to stay in the B class neighborhoods, B plus, A minus, even an A, but that's more expensive. The numbers don't look as sexy in the short term, but they tend to have stronger appreciation potential long term. But cheaper is not better. And what happens is, if you're buying cheaper properties, they're often in sketchier or less desirable neighborhoods, what I'll call C class neighborhoods. And your tenant demographic is going to be different. You have to just learn to accept the type of customer you're going to have, that demographic. The amenities in those areas are going to be different. The tenant turnover is going to be different. The care and attention to your property by those tenants, that tenant class, is going to be different than what you might find, or probably will find, in A-class neighborhoods. Just think about where you live. Break up the city into A, B, and C class neighborhoods, and think about what's there, what the neighborhoods look like, the streets look like, what the basic demographic is of the people who live there. How they live, what they drive, what the lawn looks like. Are properties well groomed and taken care of? All that kind of stuff. Neighborhoods play a significant role, and I put a lot of weight in the neighborhood, not just the market, but the neighborhood specifically. And, one of my 10 rules for successful real estate investing is to take a top-down approach. That means you don't look at the property first. You look at the market. You look at the overall market, maybe the metro area. Then you look at the market. Then you look at a sub-market. And then you work your way down to the neighborhoods that you want to invest in, where the numbers make sense. There's inventory. The numbers pencil out. And it's the type of demographic you want to deal with as a landlord. So you just have to, break it down, and it's not that hard. The information is out there. It's plenty of it. A lot of it's free. Search engines like Google will help you find a lot of the information you're looking for. In fact, on our website, there's tons of it. We post every single day on our blog. at noradarealestate.com. So just go to noradarealestate.com and go to the blog and do a search for the city or the metro you're looking for. You'll find all kinds of great information. Now, to your comment about buying cash, buying all cash is not always the best thing to do. If if you're not trying to grow and scale your portfolio as quickly as you can, then leverage is not that important to you. You'll just have a debt-free property or properties, and it'll pretty much be all cash flow. Property taxes, insurance, property tax, insurance, and your property management is what you're going to be paying for. There's no debt service, so you're going to maximize your cash flow at that point. And then as time goes on, if your rents increase faster than your expenses, your cash flows are going to increase even more. But if you're looking to grow and scale, you're going to have to look at using leverage, and it doesn't have to be maximum leverage at 80%. You could do 75, 70%, even less. You don't have to maximize fully, but leverage is definitely going to help you grow your portfolio faster and scale that portfolio quicker, especially if you have aggressive goals or you're on a timeline to build a portfolio. So, I'm thinking here that, when it comes to leverage and mortgage financing, I consider that to be good debt. There's good debt, bad debt. Bad debt is consumer debt. It's things that are doodads, as Robert Kiyosaki would say. It's money being spent on stuff that really doesn't generate income or a return. It's questionable even with art and collectibles. Maybe that's an investment in some people's eyes, but if you're taking on debt, make sure that you have the ability to repay that debt, that you can service the debt in some way, shape, or form. And real estate is great for this, because when you buy real estate the right way, you can service the debt and all the expenses on the property, leaving you something left over called cash flow or positive cash flow. And that's the income from the property. And sometimes that doesn't happen in the first year or two, especially with new construction. It might be very low, maybe doesn't look all that great on paper initially, but it does grow over time, over the years, as your expenses are relatively fixed. Your debt service is definitely fixed, but your rents will go up over time. So keep in mind that there's good debt and bad debt. Try and focus your investments using good debt. That's the best way to go about it. And then, as far as what happened to you back in 2008, that sucks. You lost some properties in your portfolio, but that created fear in a lot of people. And you have to be mindful and conscious of the fact that you are, coming out of that 2008 recession with your tail between your legs. But don't let that fear drive your decisions. Avoid the fear that you have from 2008 in making good decisions. Don't let it hold you back. I guess that's my point, is don't let that fear from the loss in 2008. The best thing to do is let that fear drive you forward. Look at the mistakes you've made. Why did those mistakes happen? And don't repeat those same mistakes. And often what it was back then is a lot of people were speculating on real estate, financing and leveraging it to as much as they could get, 80% or more of the purchase price. And they couldn't rent it. They couldn't service the debt. They were hoping to flip it. They couldn't flip it. And now they couldn't afford it. And then the real estate market turned and property values went down. And now all of a sudden their mortgage financing was more than what the property was worth. So they couldn't even sell the property, let alone carry it. And that was purely a speculative play. That is not something I would argue is or was a logical, rational investment. But leverage will get you there faster. It allows you to take your investment capital and leverage it up to as much as 5-to-1, which means that you could put 20% down on a property and borrow the other 80% and have 100% of the benefits, even though you're only investing 20% of the purchase price, which is a beautiful thing about real estate. It's a powerful thing. So use that leverage wisely. It can be a very, very powerful tool. Yes, it's a two-edged sword, but it can be a very, very powerful tool. So again, none of this today is financial advice. Use debt responsibly, make your investment decisions wisely, and learn to be market agnostic. Don't be married to any specific market. Choose your markets based on where your investment dollars will go the furthest. And then I guess in wrapping up, you mentioned a HELOC. A HELOC can be a great, powerful tool because you can get very inexpensive debt financing on your property that you could use like as if it was a checkbook. You just use it as you need it, but you have to just run the numbers. It's all math. You have to just run the numbers and see, one, if you can service the debt on that home equity line of credit, and how long you need to service that debt before you have to pay it back, and how you're going to be able to do that. And with real estate, often it means that you have enough cash flow to service the debt over a period of time, 3 years, 5 years, 7 years, maybe as much as 10 years. But at some point, you're going to refinance that property that you used the HELOC to purchase as the down payment to pay off the HELOC. So you'll refinance it and establish a new first mortgage on that property that in the course of that refinance, you're going to pay off the home equity line of credit. Now you're, back to having one mortgage. You've essentially reset the clock if you want to, and then just continue forward. So the HELOC can help you acquire more property faster. Just have a plan, which doesn't always work out exactly the way you want it to, but have a plan that you can refinance it. Now here's the variable that you won't be able to predict: where mortgage rates or interest rates will be in 3 years, 5 years, 7 years, 10 years from now, when it comes time for you to pull the trigger on refinancing and paying that HELOC off. If you have enough cash flow, you could certainly pay the HELOC down, and it would be an easier thing to refinance down the road. So, these are just things that you can forecast, on paper or in a spreadsheet, and just make some assumptions, but see how it's going to look 3 years, 5 years, 7 years down the road with reasonable appreciation rates and, reasonable assumptions for mortgage rates when it comes time to refinance. So Shane, a lot of great stuff here, a lot of great questions. I'm not even sure what to title this particular episode yet because there's just a lot of good stuff here. But thank you for submitting your question. And anybody listening to this who has a question about real estate or investing or finance or anything, whatever it may be, even a personal question, just send it over to me. You can go to passiverealestateinvesting.com and submit your question. There's a link or a button there. It says Ask Marco. Just send that in. I will see that, and I will do my best to answer it on another episode here. All right. Well, remember to subscribe if you haven't done so already. Share the show with other friends, family, like-minded individuals. Leave us a rating and review on iTunes. I greatly appreciate all the positive comments and the 5-star reviews. It means a lot to me. And that is it for today. So thank you for listening, and I will see you all on our next episode.